Well, hello again, Maverick Traders. Welcome to your Psychology Corner. Today, we're going to explore news cycles and look at how news impacts stocks, why oftentimes it's already priced in. So, by the time the general public comes aggressively to buy or aggressively to sell, they're offsides, they're on the wrong side of the trade, and they don't understand that it was already priced in and what that means. We're going to explore that a little bit more fully. As always, make sure that these things fit in your trading plan. So let's talk about news. It's amazing that the amount of news that happens in the world each day always just exactly fits the newspaper. I thought this was a funny quote because, look, they're always going to find something to talk about, right? In the stock market, they call this climbing the wall of worry. It doesn't matter what time period you live through, the stock market had to deal with news because they're going to find stories and they're going to make those stories as big and emotional as possible. The most extreme positivity, the most extreme negativity, whether that's accurate or not, that's what news does, right? They have to sell papers, they have to get clicks, and so they need to make something into a story. And you know, the idea that they're going to fill up that airspace with something is always going to be there. So that's going to continue. That is something you can absolutely bet on, is that the news stories are not going away for companies and for industries and for sectors and so forth. So when we think about any news that comes out, here's the filter that I like to take it through, and I think this makes sense psychologically if you take a step back and think about it. I call it knowns versus unknowns. And the idea here is that many things in the market are already known, and so they have a chance of being priced in. So, what's an example of a known unknown? Well, anything that's scheduled on a calendar, already, advertised and so forth, they're a known, and there can be unknown aspects to it. A Fed meeting. We just had one on Wednesday. These happen 8 times a year. They're scheduled out. They happen on a Wednesday at 2 o'clock p.m. Eastern Time. That's known. That's a big known portion of it. And then there are unknown aspects to it, but a lot of times even that's known. And this was part of my argument in the market roundup this week. I said, look, I think the market rallies. I think this is already, are they going to come out with some hawkish things? Yes, but that should be priced into assets. And so everyone was super on edge and nervous. Of course, there could have been something completely unknown and they just blindside the market with it. But the Fed doesn't want to do that. That's exactly the opposite of what they're trying to do. They try to be transparent, get the markets prepared for things, and so on. So even though we didn't know exactly what they were going to do, we kind of did. We knew they were not going to change rates. We knew that they were going to taper off bond purchases. We knew a lot about it. So it's kind of a known. There were just a couple of little elements that were unknown, but not really. So, what about economic reports? Again, it's on a calendar. We know that non-farm payrolls come out the first Friday of every month, et cetera, et cetera. We don't know what the numbers will be, but even that we can oftentimes get a sense of, what the expectations are. Take the CPI last Friday. Everybody's worried about inflation because it's up near, it's 6.8% for the year, for the calendar year. Well, everyone was nervous going into that because the expectations were that inflation could hit that 7%. Instead, it came in at 6.8, which is a crazy high number, but because it missed expectations, the market breathed a sigh of relief. So it was a known unknown, and you have to think about, how is the market positioned? What is the market fearful of? And is that already priced in? And then, maybe we get a better number. And that's what happened on Friday. You actually saw a better than expected number. So even though inflation is high, it didn't hit as high a number as markets had feared. Earnings announcements. Again, this is a known unknown. It's why earnings can oftentimes be a dud. There are entire trading strategies that take advantage of implied volatility collapsing, what they call the volatility crush around earnings. New traders oftentimes buy a lot of options going into earnings because they're like, oh, the stock tends to gap. And then the stock will gap and they still lose money and they go, well, how's that even possible? It gapped in the direction. I bought a call and it gapped up. How did I lose money? Well, the volatility crushed. And so even though it went in your favor, you still lost money in the option value. And so, a lot of those things can be priced in, even though there is an unknown part of that. Unknown unknowns, now those are different. These come out of nowhere and they're not on a calendar, so therefore they cannot be priced in. A natural disaster, wars out, breaking out, pandemics, Fed buying bond program at the crisis. This one I'm talking about when they announced it, when the market was cascading lower in COVID in March of 2020, the Fed announced a bond buying program which basically stabilized the markets, and that was a positive unknown. Scientific discoveries, vaccines, if there's a cure for cancer, these are things that can be negative or positive. In 2020, we saw a full-fledged pandemic breakout, which got so bad that, the entire world kind of stopped. Economic activity came to a screeching halt. And then there was a positive down at the bottom. The Fed came in with bond buying program. They printed trillions of dollars. They started sending out checks to citizens. And so you saw an unknown that was positive, a for stocks anyways. Now you can argue whether that's a good thing, bad thing long term, but it surely was a good thing for stocks. So these are things that are not scheduled, not known ahead of time, and then you have all the question marks in regards to them. Now, you still need to take these through a filter to ask yourself, just because it's an unknown, they're not all created equal, right? So the market tends to worry about the last crisis for far too long. I'm going to highlight pandemics because I know that this, COVID's going to have variants. We know that. And every time there's a new variant that starts to show bad data, the market is going to panic. And oh, by the way, there might be risks of other potential pandemics coming, right? This isn't the first one. Yeah, COVID was a full-fledged pandemic, but we had SARS and we had, all these others that could have, I guess, materialized, and they normally don't. So here's what you're going to see over the next few years is every time a new thing pops up, the market in its mind is going to have a knee-jerk reaction, and it's going to have this reflexive memory where it remembers how bad it got in March of 2020, and there will just be some initial panic. But guess what? You have to run this through your filter and go, okay, wait a second. Is this going to be a repeat of March 2020? The odds of that are extremely low. What are the odds, even with this recent variant that we don't know a ton about? It was my argument that, look, the data is going to get bad, but do you really think that everything's going to shut down? That's not to say that they won't, halt travel to certain areas, or, people might fly a little less. Sure, it will hurt some industries, but my opinion anyway is that the market will overreact to these health concerns from a market perspective. I'm not discounting the reality of the world we live in, right? You got to take care of your health and so on. But I'm just saying, I suspect that any risk of a new pandemic, a variant, people will in their mind envision March 2020. So you'll get a knee jerk reaction down, but it's not going to evolve into that. And ultimately, will probably bounce back and recover and be a buying opportunity, just that in a vacuum. Now, there might be other reasons. It might do a relay race, like people panic on that and then they sell for other reasons, and it just kind of evolves. The market could stay bearish, but it won't be probably from that. It's kind of, again, the market's always in panic mode about the last crisis. And so we've got to deal with that, but the market's probably going to overreact to every thing that comes out in regards to pandemics for the next number of years. I'm reminded of BP. That you know what BP stands for? Broken pipe, right? So BP had this broken pipe, and for a few weeks, I mean, they couldn't get that thing stopped, and they would just show that. And this was an unknown for a company. It was the worst kind that nobody expected it. And then it was all the, hey, is this company going to go under? How could they ever survive? And so on. And it took down the entire energy sector. And for the next few years, if there was any type of leak or any, it was a front page story, and traders would panic about that energy company. They would say, oh, this could be the next BP. How many more do you think turned into the next BP? Big zero. So essentially, again, the panic over the past recent unknown unknowns is always going to be there. Now, will there be another one here that comes up and that really derails the markets? And I don't know what it's going to be. It could be, crypto related. It could be this, it could be that. I don't know what it'll be, but there will be some sort of panic. And then everything that looks like it could be that in the future, they'll panic over for a few weeks here and there. And those will, ultimately not evolve into that. That's the general pattern. So when you take something like this COVID variant, yes, it's an unknown unknown. We didn't have that variant schedule. We knew they were coming, right? But we didn't know about this one, and we don't know how infectious it is. We don't know how severe it is. We don't know what that means for the economies and so on. A lot of question marks. So they'll just sell off and they'll see March 2020 in their mind's eye and they'll panic, right? But then as you start to get the data, it's probably not going to evolve into that dire of a situation. That's what normally happens in these circumstances. Look, the healthcare community does an incredible job. They're going to work overtime to find new vaccine, this and that, and we're just probably not going back to as bad a situation as that one. That's the trade. That's how I would run it through the filter. That's my take. And that, by the way, that's what's working so far. When they panicked on Delta, the variant of COVID, it was a buying opportunity. When they panicked just now in the last couple of weeks over the Omicron variant, well, guess what? We're now at new highs today and so forth. So, anyway, I'm not suggesting that we have to rally immediately. There will be a few days of aggressive selling. There will be that panic that sets in, and then there will typically be that pickup, and it won't kind of evolve into that. So when we're looking at news, first thing I do personally, I say, okay, is this a known unknown or is it an unknown unknown? I know that knowns will already be priced into the assets oftentimes. I know that unknown unknowns will not. They can't be priced in because they came out of nowhere. But these are not all created equal. If these are unknown unknowns that are kind of an offshoot from the last crisis, I know the market will probably overreact to them. If this is a brand new thing, and oh, by the way, you'll see little markings of things in the financial markets. If you're paying attention, you'll know whether there's real stress. And this is for short term trading, but what happens in times that, really are bad for the market? Well, you'll start to see things like credit markets go crazy. Bond values will drop and yields will go up. And you'll see things like a good telltale sign was like Boeing and Delta and all these companies. They started tapping into their emergency credit facilities. Basically, they have, these credit arms with big financial institutions. And Boeing said, hey, we're going to cash in all of that. We're going to, before you can remove it from our grasp, we're going to take that, emergency $2 billion that we have with you as a bank. We're going to take that money. There's little signs that tell you there's true stress in the markets. So kind of watch for those on the financial side. There will be a point when all of that gets priced in and that panic's overdone. Usually, at least of late, the last number of years, when there's a true market kind of panic, And it really starts to ripple through other financial assets and markets, and they're going crazy. You'll hear, okay, the Fed stepped in. There will be, anytime the Fed, the Treasury Secretary, all these people are meeting together for emergency meetings, it's going to get worse in the short term. But then when there's things that actually roll out and they're backstopping and they're going to print as much money as they want, okay, now it won't. They're kind of creating a positive unknown unknown. Unknown unknowns definitely create more volatility because again, they're not priced in. So the market has to go through a repricing of things. Some traders have a little different trading plan for volatile periods. They might say, okay, if hit with an unknown unknown and I start to see these drivers, I go to smaller positions count. I don't trade as many positions. I might go smaller position sizes. Doesn't mean you stop trading, but you might have basically a shift in your plan for dealing with these sorts of extreme volatility spikes. That would be kind of the concept of, how big is this, and trying to put it through your filters and really figure out what type of unknown unknown this is. Hope you've enjoyed this class on the psychology corner of trading news events. Have a great rest of your day. We will see you next time. Goodbye, everyone.